Welcome, everyone. Thanks a lot for tuning in. As always, this is Steve Taylor. I'm the founder and lead advisor over here at Merited Wealth. And if this is your first time tuning in, welcome. Thank you very much. If you tuned in before, thanks a lot. Thanks a lot for coming in. And we hope you're finding these podcasts and these videos very valuable. So today we're recording another episode. There's two formats in which we do the podcast. One is an interview format about entrepreneurs, and the other one is more topic focused with experts. And we call those thoughts in growth mode. And this is what that format that we have today. And so we go through, we'll go through this. If you like this topic or whatever it might be, if you want to be a future guest, whatever it might be, please reach out to me. But today is going to be a really interesting topic, and I'd like to, we got a great expert I'm going to introduce here in a moment. This is something, a lot of knowledge I wish here that probably maybe I've had it in the past, right? But I'm sure there's a lot of people out there trying to, when they're starting up businesses or they develop a product or whatever it might be, the big question always comes up about fundraising, right? When do we go get funds? At what point do we need it? Do we need it multiple times? What are some thoughts and ideas behind that? And that can really be a big challenge for those out there trying to start their business. So let me first and foremost introduce our esteemed guest, Matt Wolf. Matt, tell us a little bit about yourself and your business and what you do and what makes you particularly qualified to this discussion.
Sure. No, thanks, Steve, for inviting me. I'm looking forward to having a nice, fruitful conversation today. So yeah, I'm Matt Wolf. I am the head of advisory for Joorney Business Plans, which is headquartered in Miami Beach, Florida. We've been around for about 10 years now. I've been with the company leading this division that I helped create for about 6.5 years.
Wonderful, wonderful. So Matt, let's dive in, right? And let me start, maybe we can, a fun way to walk through this will be through my own personal experience, right? And going through this and developing a product, developing a business and going through this. As some people may know, a number of years ago, my wife and I, we developed a baby product and we got on the show Shark Tank. And it was a whirlwind. It was a huge, learning experience and everything to go through this. But one of the biggest things that always kept coming up, and I don't know that we did it the right way and everything, but we developed a product, right? We had this baby product we went through, we used our own money, we trial and errored it and all the like. And, that's what we had. Other ones out there that might have business ideas and everything like that. But when we were starting, we didn't know what we didn't know, right? And we didn't know where money could have helped and at what stage we would go get money. So for people out there that have a good idea, right, whether it be on a product, a business idea, or items like that are looking, to initially kind of like what are the best steps to get this going, and when and how should they initially look at fundraising? What do you see out there with entrepreneurs? What's some of the advice that you're giving to them for that initial stage? You're kind of trying to figure out your product. Maybe you figured out your product, and how does that dovetail into going out there and looking for investments?
Sure. No, great question. I think it really depends on what the founding team or the entrepreneur is building. Is it a highly scalable tech solution to a problem? Is it a brick and mortar thing, restaurant, franchise, even something like that? But I usually recommend to most people that I speak to, try to bring it, whatever it is, as far as you can before looking to go get funding. Try to bootstrap as much as you possibly can. Now, obviously, everybody has different means, different bank accounts, and different friends and family, and so on and so forth. But that being said, try to bring it as far as you can before you start to go look for funding. And depending on what the thing is that you're building, product or service, will determine what options you've got in terms of funding. Is it going to be equity? Is it going to be convertible note, a safe? Is it going to be the SBA? Is it going to be some form of debt? So it really kind of depends on what that founding team, that entrepreneur is building to determine, when they're going to, when would be a good idea to look for funding and the structure of that type of funding.
Yeah, so I think that's great advice, Matt. They want to get this as far as possible as they can. So I know with us, it was a challenge, and I was trying to be real disciplined with my wife that we only spend the money that we have, right? The extra money on this. And I've seen other people though that will go into debt, right? Potentially home loans and items like that. What have you seen in your experience, right? I appreciate that idea. They want to get as far as possible, but many times we're dealing with people that maybe don't have any previous business experience in doing this. What are some of the caveats or things that you've seen for people that might know that, yeah, they want to get as far as they can, but when did they go too far, right? When did they put themselves in a more difficult position that it's going to make it look a little different to get that kind of first round of funding?
Yeah, that's a good question. There's probably a question that you could answer, Steve, but I'm not a proponent of overextending oneself, going into debt, taking out your 401k, paying a heavy tax on that to try to bring your idea to fruition. If you just look at the statistics of startups that make it all the way, I mean, the numbers are kind of against you. That doesn't mean you shouldn't go out and try to do something on your own. Obviously, I'm not saying that, but use your brain, don't overextend yourself, don't go into massive debt to try to build the thing, because you just don't want to take on too much risk. And that could be very well be someone's nest egg, someone's family's nest egg, and their kids got to go to school and all of these things. Don't do that. That's not a good idea to do that. That being said, depending on what the person is building, they're going to need resources, financial, human capital as well. And usually what I tell people, and this is kind of a conundrum that people kind of have, they're a founder. I have this idea. It's a vision for something. I need people to join me in building this, but I don't have the funds to pay them. So how do I bring them on board? So that's where the concept, the idea, the formulation of that idea, you're solving a problem with this particular solution. It has to be so intriguing, so delectable, I guess you could even say, to be able to intrigue and entice somebody to drink the Kool-Aid, so to speak, and join you in this vision and going with you as a co-founder, co-founding team to realize this vision. And if they believe in it enough, they'll hopefully be able to take a smaller salary or work, with equity, have co-founder shares in the company. And then as they kind of progress through fundraising rounds, obviously the salaries can start to pick up. But you've got to be able to, and this is really key for the CEO, the person that's running the venture, whether it's a small business or small businesses looking for funding or a highly scalable tech startup, you've got to be able to convince other people. You're always in sales mode. Convince other people to join your cause. You're going to have to do that with the investors. You're going to have to do that with co-founders as well. So that's usually the advice that I give.
Yeah, that's great advice, and I see that all the time. That was something we personally went through, and I see other entrepreneurs go through that. That when you're getting started, right, and you need the help, and you want more hands on deck, it's very easy to a certain degree to, hey, listen, let me give you a part of the deal, right? Let me give you some equity, and it's always a challenge in that, hey, how valuable is your equity going to be, right? And are you giving more equity than maybe the job or what this other person is kind of bringing to the table, right? For you and for those services. So to that point, that's fairly common, right? One person will come up with the idea, maybe some other person has a know-how, maybe some person takes, some initial money and brings that in. So once these groups get together and they have these founders, right, and they're going for that seed capital, where a company like you, advisors start, coming in. What are some of the maybe some of the situations that you've seen and how those initial deals get structured, how they brought in those initial people that potentially really harms their chances of getting this equity, right, from an outside investor, right? Whether they gave away too much equity to start with, whether the terms of their operating agreement weren't that good. What are some things you've seen in those early on that they go for that? Maybe we're at the seed round of funding, right? Or maybe we're at level 2, whatever it might be. what are some of the deal terms that you've seen that founders maybe, you know, some things they agreed to that really didn't help them out when they started to get that outside investing?
Yeah, no, that's a good question. I think, KISS, right? Keep it simple, stupid.
Uh-huh.
Uh, I think that that's good wisdom for when somebody's starting something up and they're bringing on a co-founder. You really want to make sure that that co-founder, whether it's another co-founder or another two, to have three people in the team, these are people that you're going to be stuck with for a long time. And I don't mean stuck as in a negative connotation, but you really want to be able to get along with them personally, professionally. They're going to be responsible. They're going to be committed to really realizing the vision. You even should look at, their family situation, their financial situation without being too probing. If they've got financial difficulties, if they've got maybe some problems at home, those are risk factors there. So as an example, if you bring on co-founders, maybe they're excellent at what they do, but they have some of these risk factors, even though you may be friends with them, that may not be a good person to bring on board, because when the going gets tough and everyone's kind of pouring in their time and whatever funds that they've got in their pockets, and something goes wrong at home, or there's some health issue that comes up, and now suddenly that co-founder has to spend their time doing this and not focusing on building the thing, this is a problem. I mean, obviously life happens, but that's not going to help the venture grow and grow to fruition. So these are things that you really kind of have to take a look at. And you don't want a co-founder to be, vested, have their actual shares in the company as it's starting up. And then, oh, okay, we're going to do it 50-50 or thirds. And then 3 months into it, there's a family problem or there's a financial problem, or they got laid off from their job and they immediately have to leave. And the rest of the two or the single founder is picking up the slack for all, for the entire company. While those other people that ended up leaving, or that other founder that had to leave, retains their 50% or 33% shareholding. That's not fair. That doesn't make sense. So that's really important. Whether it's someone's looking for investment or just having a partnership with another person or another couple people building some business, really kind of take a look at who you're partnering with. Of course, it's good to get along with them. It's great to, I'm going to hire my friend and this and that because we get along so well. That's not the only factor that someone should be looking at when they're deciding on who to bring on as a team. And if that group of people is going to eventually raise money, now you've got investors looking at it as well, looking at those dynamics as well, making sure that this is the team that's got the skill set and the expertise and the ability to pivot and the nimbleness to be able to build the vision and go all the way. Because I, as an investor, I'm putting money into this team. Team is number one. Team is paramount. It's bigger. It's the deciding factor in an investor investing in something. You can have, I think the saying is something like, you can have an A product and a B team, and that's not as good as the other way around. Because there's so many pivots that a startup has to go through that no one can really anticipate. And you've got to have a team that's cohesive, that has, they don't have a lot of baggage or anything at home or financial or family problems or anything like that. Because when the going gets tough, they've got to be able to move as a singular unit to build the thing, to build the vision.
That's great advice, man. I love that advice. And it's amazing how many times this comes up in these conversations, that people coming together and doing business together, we all tend to want to do it with our friend. And we think because we get along that's going to equate to business. And so many times that's not the case. And that's risky. I've been there with my legal practice early on. With our little business, it was my wife and I. So we were all in this together, whether better for worse. But that the team is everything. You make a great point about really trying to make that due diligence about the other team member, right? Their background, those outside influences. Let me ask you, what do you see when the investor comes in to start giving that money? I mean, are you seeing them doing background checks? Are they requiring the owners kind of giving financial, affidavits? I'm wondering of how stringent that is when the investor comes in, that it might be a good idea to apply that yourself, right? When you're considering who to give equity to.
Yeah, no, exactly. You're exactly right, Steve. The founder should be doing those due diligence, efforts before they bring somebody on. And again, just like I mentioned before, oh, it's easy. I'm going to hire my friend. I'm going to share the idea with them, this concept, this vision, to have them join. Not so fast. Okay. You really want to make sure that you do the hard work beforehand, because this is a person that could potentially be with you in building this thing that is going to be life-changing, maybe not just for you, but maybe for all the audience that you're serving. It's a very, very, very important step. So that's paramount. Now, if you do those things and everything checks out, now you have the team, you're building the thing, and then you go out for seed funding. Now there's a potential investor that's interested. Okay, so now they're going to go through due diligence. There's not a lot of company due diligence because there's not really a company there yet. I mean, legally there is a structure, but there's no revenue generation. There's no P&L. Really, it's really a kind of a hope and a dream and a strategy. So what are they going to be due diligence on? They're going to be doing due diligence on the people, on the team, some background checks. Everybody's a little bit different in how they do due diligence. They're going to do referrals. Where did I meet this investor? Was this a cold call, a cold email? Was it a warm intro? Who gave me the warm intro? What's their background? So they're really going to be kind of looking at the mosaic of all the different ways that they could do due diligence on the team themselves. And again, everyone's kind of different. Every investor is a little bit different, but again, the team is paramount, and this is the only thing that they could really kind of dive into to get comfortable, for the investor to get comfortable with this opportunity, investing their money in this team and then going forward. So it's very good advice, again, for that founder to really check out. Take your time, really check out who you're looking to bring on board. Make sure, to the best of your ability, that they're the right one or two people before you really start going forward.
Yeah, that's great. It's all about people. So now we're up and running. We have the product, we have the idea, we have our team together, right? We're going out and we're looking to get funding. And I think when we went through it personally, right, someone that at the time had never been through this, it's interesting in that when you start to go look for funding, it's like, kind of, how much do you ask for? Why are you asking for it? And what I found really interesting as I started working with other companies and experiencing it is that you don't really ask for funding only once. There's levels of funding, right? There's step one, there's step two, there's step three. So, maybe if you can give us a little outline to people so they're thinking longer term, kind of like, what should your initial level of funding, like what should you ask to get to X point, right? And then once you get to X point, what's your funding looking like that? Kind of what are those stages of funding? I think it would help people to know and to say, okay, we're doing step one, accomplish that, and going through that. Because for us, when we were going through it, we never did ask for money from anybody. And I think it was a bad idea, because we should have gotten it. It was a good product. It had ability. But how do those steps of funding look?
Yeah, no, great question. So I'll just speak about, a tech startup, some random tech startup. So there's, as you mentioned, there's different stages of funding, but not everybody avails each of those different stages. But I will take just an average case of a tech company kind of running through all the different stages. So number one, friends and family, right? And as I mentioned before, everyone's got different means. Everyone's got different friends and different family with different bank accounts, right? So not everybody has friends and family that's going to, put in $500,000 or something like that. And this isn't even a round that everybody avails, as I mentioned. So that being said, it is typically, if someone is raising money through every single round, friends and family is typically a first round. It could be, $5,000 up to $100,000. And there's a very wide range there, because different family, different friends, different bank accounts, etc. So that's number one. Number two, pre-seed. Okay, so I kind of define pre-seed as, I need to raise money to build the thing, the product or service. I don't have the funds myself, or through friends and family, I don't have those funds to be able to build the thing. So there's risk there in building the thing, depending on how complicated the technology is or how easy the technology is, how simple the technology is. So, usually pre-seed, I would say, is 100,000 to maybe $300,000 or $500,000 thereabouts to build this thing. Again, I'm kind of taking, this is a bit simplistic. I'm taking averages. There are things beyond that. There's things below that, but that's kind of generally the range. So let's say it takes 6 months, 9 months to develop a thing. So that's your runway. That pre-seed round that you've raised, let's call it $300,000. You use that money to build the thing. Okay, now the thing is hopefully built, okay? And you've reached kind of the end of that runway. Well, now you need money to go to market. You need to prove that there's a product market fit. You built the thing, you got to go to market, and you need funds to go to market. If you've got a digital advertising strategy, it's a consumer-based product. I'm going to be selling it through, my website, e-commerce or something like that. I need funds to plow into digital advertising to get people to come on my website and buy the thing, right? And we're assuming that you don't have those funds. So now you need to go raise seed. That's seed. It's the funds that are used to establish product market fit. What I generally advise our clients is you want to raise seed, and most of our clients at Joorney are seed. They built the thing. Now they're at seed. They need to raise between, I'd say, $1 to $3 million is kind of the range of seed. On average, it's around $2 million. They need that money to maybe do a little bit of hiring, maybe boost a little bit of salary, maybe. But really, it's all about finding that product market fit. This is the hardest part. People build things, and the number one reason that startups fail, you'd be surprised, is we built a product for a market of like 2 people or something. It's like, oh, the founders had this vision. Oh, okay, we're going to build this thing because we have this problem. But they didn't do the market research to really see how widespread is this problem? Is this really just a problem for us, or is it really widespread? And I always encourage, do your diligence, look at the market, look at market research to really see if there's going to be a product market fit, because if there's not going to be, you're just wasting your time. So that $2 million goes towards marketing and advertising to try to get sales, to establish that product market fit. And maybe there isn't revenue generation if you're just trying to grab, whether it's market share or just a large audience that are coming to your thing. Whatever that is, you need to be able to establish and demonstrate that you've gotten traction in that seed round. If you do that and you need money at that point, then you're in Series A. That starts to open up the possibilities of different types of investors, venture capital. A lot of people are like, oh, I want to go raise VC money, venture capital money. They haven't built the thing yet. Well, VCs, they do dabble in seed, but most of them like to see some revenue generation before they go forward. They are early stage investors, but they're not super, super early. So they want some risk kind of eliminated there. The thing has been built, so there's no technology risk in building the thing. There's product market fit established through seed, through angel investors who put in seed capital. So now I'm a VC, venture capitalist. Now I'm looking, to put in money to this Series A. This could be between, I don't know, I'd say $5 to maybe even $15 million range. So as you kind of go through these different stages and you hit these milestones, your valuation is obviously going to go higher and higher, hopefully. Now, again, this is kind of a plain vanilla, setup here. There are cases that are adverse. What if you don't hit your milestones and now you've run out of money and you haven't established product market fit? What happens then? So now your financing options become a lot more limited because you might have to raise a down round. You might have to do some creative structuring things. Life gets a lot more difficult when you don't achieve those milestones. So this isn't tiddlywinks. This isn't very easy stuff. It's very, very difficult to do. And the analogy is, someone gets thrown off of a cliff and they have to build the airplane, while they're falling down, get into the cockpit, know how to fly the plane, and then pick it all the way back up. And that kind of descent is your runway. It's your money. And so if you run out of money, you run out of runway, splat, it's over.
Yeah, Matt, that was an awesome how you laid that out and the different stages and what you're doing and the amounts. I really like that. I think hopefully those listening can see that and understand that. I'll tell you briefly for us, what we did, and I think a lot of these, entrepreneurs do, is we came up with this idea, right? We had this product, my wife decided this baby bib, it was made out of material, all this stuff. And we said, okay, let's go put some money into developing the product. So we went and used our own money over a period of time to develop the product, right? I think over a certain number of years, let's say we were 100,000 or whatever it might be into it. And it's interesting at that time, because most of our resources were going into that, developing the product. My wife would go out to these little shows. We knew it was a great product. And we didn't think as closely to what you say is kind of once you've built it, kind of that seed, like that marketing, advertising, sales, right? Go out there and get it. We were focusing so much on the product, we didn't think about that. And so we got really, really lucky being on Shark Tank, right? Because we got that for free. We got our product put in every household in the world kind of for free, but we weren't ready for the infrastructure then with a professional team to kind of take it to the next level and everything like that. And so as you laid it out, it would have been unbelievably to have someone like you, and that we could have anticipated and seen that after we make the thing, right, that we're going to need to market it and sell it and kind of see that trajectory. And then only once you get those sales, because a lot of people approached us after Shark Tank, and yeah, we had a huge bump in sales after the show, but after that, it didn't matter. They didn't care anymore. Like the VCs, you say, they don't care. The investors, they want to see sales, right? And they're going to get that Series A, that funding out there. So that was a great thing. And I think, those that kind of just bootstrapping it on their own, don't have professional like you, we kind of put it out of order. I think we put too much money into the thing, not understanding that was only half of the first part of it, because then we have to be able to market the thing and sell the thing. And we were kind of out of our money at that point. So let me ask you, Matt, as you go through this, and I think your summary there was outstanding. I love that. And I know you can't, every deal is different or anything like that, but like kind of my concern with probably most people would be, okay, so to grow this and get to that next level, if someone's wise, that you hear that saying, I'd rather own 1% of something that's worth $1 billion rather than 100% of something that's worth nothing. As you're going to get diluted, and as the founder, and as you're selling these investments, let's say someone goes along this path. Let's say they get, I think a big win would be at venture capital level, right? You get venture capital investment in there. Now this is a real company, right? This is worth something. Your valuation is there. What do you see in a range, the founders kind of as they're going through this? What's an idea of how much do they get? I'm not going to say diluted, but how much of the company do they have to get, to give away so that they're at this VC level? Like, once again, there might not be a quick and easy answer, but to say that, okay, what should I expect? What percentage of my ownership to be at that point? Because then I would think you want to solve backwards. And as you're giving out the little slivers along the way, you don't want to give away too much too early.
Yeah, it's a great question. It's not very easy to answer because every situation is different. I will say this, though. I think that founders oftentimes, especially if they haven't done it before, and by it, I mean build something and go raise outside capital to grow it, there could be an overemphasis on retaining shareholding for the founding team. If you can't get the money, you can't grow the thing. It's that simple. Now, that being said, that doesn't mean, oh, I'm going to give away everything. That's also bad. So what's the right amount of money to raise? What's the right amount of shareholding to give up? It's the perfect amount. It's, every situation is different. Generally speaking, though, through the different fundraising rounds, pre-seed, seed, Series A, people are generally giving up between 15 and 25%. Okay. So, again, that's on average, it's in general, call it 20% or so. Not everybody goes through, Series A, B, C, D, you know, all the way through. And as the company becomes more mature, other options for finance start to open up. So in Series B and beyond, maybe you can now take on debt to go make acquisitions because you built this thing and there's so many competitors coming into it because you've done such a good job. Now you need so much more money to start, and you know, firepower to start going out and gobbling up competitors. You don't want to take all of that in equity necessarily, because then you're going to get really diluted if I go and raise $50 million in a Series B. So maybe I go look at some debt options to do that and make those acquisitions. So it gets a little bit different as you kind of go beyond Series A. But again, going back to where I started, the overemphasis on retaining shareholding. I'll give you another example. If someone's raising $2 million and, you know, let's say that we help them, you know, at Joorney, we help them out, say, okay, this is your valuation. You're raising $2 million, pre-money valuation. So pre-money meaning before the investment, the valuation of the company before the investment. Let's say it's $8 million. Okay. So you're raising $2 million. The post-money valuation is the 8 plus 2, it's $10 million. So then the math, the arithmetic is 2 million divided by the 10 million. That's 20%. And that's what the investor gets. Okay. So let's say you have an investor on the hook and you're kind of going through the process. And now you've gotten to the final stage, which is negotiation on price. If that investor says, and you already have in mind, okay, my valuation, I'm going to give up 20%, you know, thereabouts. The investor says, okay, I'm going to write you a $2 million check right now, but I want 25%. Are you not going to do that deal?
Mm-hmm.
You're going to do the deal. Okay. So what I'm saying is don't get too hung up on, you know, these kind of smallish numbers. Because if it really goes all the way, you know, this is going to be crumbs. It's really not going to be anything. But what's more important is you need that funding to go all the way. Now, if that investor says, I'll give you $2 million for 40%, that's too much. Okay. Mm-hmm. There's a difference between 25% offering and a 40% offering. Another thing to keep in mind, also very important, don't give up everything. So, okay, I need to bring on let's say I need to bring on pre-seed. I'm going to give them 40%. Okay, now I need to go raise seed. I'm going to give them another 40%. Well, what gets complicated there, even if that person, that founder might be satisfied with their 20 or whatever that is after they get diluted, and they start to go for like a Series A at a VC firm, that VC firm is going to say, oh, this cap table, the capitalization table, which is the shareholding of all the shareholders in the company, it's too crowded. There's not enough equity for me to now kind of, you know, take, because the founder's given up too much of this company. And so you start to kind of limit your pool of investors if you start to give away too much. So there's a problem if you give up too little. Oh, there's not enough meat on the bone. Okay. As an investor, even if it's going to be a big thing, I'm putting in money. I'm taking risk very, very early. I'm one of the first investors. I need more than 2% or something like that. And then the other spectrum, you can't give up 40%. So the right amount is in there somewhere. Again, usually between 15 and 25%, 20 on average, you'll pretty much be safe with that rule of thumb.
Matt, you're giving me flashbacks, man. I feel like I'm back on Shark Tank and Mr. Wonderful saying, well, I'll give you this for that percentage. And he's making all those jokes for us, but that's great. And I love that. You know, that's great advice. And one thing I would say also, I've seen a lot of friends and advising business owners and the like, when they get further down that road, depending on the investors they took on, if they take on potentially problematic investors, right? Or they give up too much control, right? Because we're talking about percentages of the profits, but as the control decision-making, I've seen founders get booted out. You know, I don't know if you guys stay in that late, but that happens all the time, right? So as you're going through this, that due diligence on your part as the founder to make sure you're getting in there into bed with the right people becomes even more and more critical as you go up, as they're doing their due diligence on you. Do your due diligence on them. See their track record, right? See how many times that they've gotten founders booted out of their portfolio companies or whatever they might be. That's a really a big part of this in this conversation. Matt, let me, as we're winding up here, you know, I find, you know, you're an awesome guy. I find your business very, very interesting, right? It's in the sense that because you guys get involved. You call yourself the startup, architect. You guys get involved earlier. So for someone, if they're listening and they were like us, right? They were two there was a lawyer and an artist at the time getting into this bid world. Like we didn't know anything, right?
I love it.
When is a good time for someone, to maybe reach out to you, and we'll put your information and stuff like that, that like a unique service like yours becomes most valuable? Like at what point maybe they start consulting you this when they have the idea and you give some basic guidance, or maybe they have to have created a thing. When's a good time to get someone like you kind of on board? And then maybe how long we talk about all these series of fundraising. How long do you stay on board and give advice to these entrepreneurs?
Yeah, no, great question. So at Joorney, specifically in the advisory division, we work with early stage and growth stage companies to help create the investment materials they need to go present to investors, whether that's equity investors, debt further down the road, hybrids, convertibles, and things like that. And in scope, it's a few different things: numbers, financial modeling, mapping out the business venture in terms of numbers, which would include valuation as well. Number two, investor business plan. Not if you have a software tech startup, you don't need a business plan for that. Pro tip for everybody that thinks they need a business plan: if they're building an app, tech investors don't read business plans. So what's important is knowing the materials that you need to present to investors, because you want to kind of show that you've been here and done it before, even though you may not have. And then number two, making sure that those deliverables, those materials, are the best that they could possibly be. And that's where we kind of come in and make sure that those materials are the best that they could possibly be. The third thing is the pitch deck, the short form PowerPoint presentation that's typically the first document that gets sent out to prospective investors to gauge their interest. If they like what they see, they want to learn more, I want to dig into the numbers, I want to interview you more, and then hopefully it starts to kind of materialize and go forward from there. So at Joorney, sometimes we'll have people like, I have this idea, but I could also maybe do this one. We're something that we do at the company, which is called concept selection, where we kind of, okay, where are your strengths, where are your weaknesses, and kind of help guide that founder, like, hey, this might make more sense to go this route and do this. And these are the reasons why. And these are the reasons why this other idea that you have might not be a good idea. And so how early can we start? Really, really early, all the way at the very, very beginning, deciding on, should I do this or should I do that? From there, it's kind of like, okay, I think that I want to do this. Maybe they need to put together a feasibility study to look at what the market, as I mentioned before, the market research part. The market research part, who's my audience? What's my pricing look like? I'm building this thing over there. What are the demographics of my location? All these things are important when you're kind of deciding if this is going to be the thing. And then once you have that data, that market research data, now you want to kind of build it. What does this look like financially? Is this going to be worth it for me to even, build? What do the returns look like? How much capital is going to be needed to kind of build the thing and go forward? Is it going to have to be raised from outside money? What's the structure of that going to look like? Is the thing going to be able to grow big enough so that I could entice co-founders to my team to build this with me? All these questions start to pop up. But yeah, we start at the very, very early stage through feasibility. Then they're going to raise seed capital, guiding them through that valuation, the pitch deck, all those materials. Most of our clients are in seed. A few are in A, but by that point, they've got a team, they've got financial modeling in place, they've got a deck that they can repurpose to go present to VCs. Usually when we work with them, they just don't want to put up with building the materials again, so they send it over to us. We save them time and put that together for them.
Matt, I wish I had met you about 10 years ago, my friend. This is so valuable. I can't tell anybody who's listening here the stuff you're saying. A lot of it I've since learned, but at the early stages, I had no freaking idea. And to have this guidance, when people got on the phone with me looking to invest, they could tell I didn't know what the heck I was talking about, right? I was not nearly on the same page, right?
That's the thing. It's like, you could go get an MBA, you can get an undergraduate degree, all this stuff. You're not going to learn through that structure how to build something and how to go raise money for it. This whole industry is a cottage industry, and it's developed through mentorship. That's how I learned. I learned on the job and honing my skills with all this stuff. So this is not stuff that you learn in school. People need guidance. That's why we love to work with first-time founders who haven't done it before. That's where we can bring in the most value. Like, these are all the things that you need to start to think about in order to make sure that hopefully this thing is going to be successful. So yeah, we're the place to do it.
That's awesome, Matt. Thanks so much, buddy. So we'll put your information on all the show notes and everything here. I can go on for hours and hours. Who knows? Maybe if we get some feedback, maybe we bring you back in. But I found this extraordinarily, valuable, and I've been through it, right? And I'm sure there's so many people out there that are guessing on what to do. Please, I try to mentor, like you say, I mentor them. But it's only I'm only to a certain degree, right? I did it to a certain degree. This is what you do every day. You've seen it and all the like. And so, yeah, I'm happy to have known you. I'm happy to showcase you here and show you out to other people, that if we can put you in connection with somebody at that proper time, right, early on, and get that guidance, would make all the difference in the world. Like, where do I put my money? What do we focus on? Like I explained, we didn't know. But Matt, this was really, really awesome, man. I really thank you for your time.
No, I appreciate it, Steve. Thanks for the opportunity. Hopefully it's valuable to everybody.